Hello and welcome to the Dowden Report, the first half in review. I am your host and your financial advisor, Joshua Dowden. Ahead, we will review the second quarter and the first half of 2025. But first, as I record this, Jeannie and I are making plans to head up north to Reno for the 4th of July and for Madison's baby shower. With baby Amelia due in August, it looks like we'll be headed back to Reno in just a few short weeks to see the birth of my first grandchild. Life is good. Now, the past 3 months have been a lesson in patience for investors. Volatility rattled the markets, which has since recovered and gone on to create new highs. The S&P 500 and the NASDAQ both reached record levels with impressive gains of 10.6 and 17.7 respectively over the past quarter. Bond markets were stable over the period, also delivering positive returns, with the U.S. aggregate bond index at 1.2% for the quarter. Now let's look at key drivers of the first half of 2025 and provide context for where we're headed into the second half of next year. Up first, this chart shows how the markets have performed year to date and how that compares historically. The second quarter kicked off with the uncertainty of the tariff talks on April 2nd, which proved to be a bit more drastic than what we had originally expected. However, as the administration engaged in negotiations, the pauses came, and the market sentiment gradually improved. The Middle East tensions created initial market concerns, but the stock market shrugged off the news, showing broad resilience and ultimately advanced to new highs following the announced ceasefire. The stock market recovery has been widespread, spanning multiple sectors, investment styles, and geographic regions. The second quarter saw a weaker U.S. dollar. Of course, a weaker dollar is bad for the consumer, you and me, but it's often very advantageous for U.S. businesses and exporters, which ultimately are going to drive markets. By contrast, the dollar has declined this year and is near the low end of its range since 2022, but its value still remains high compared to the past decade. On the monetary policy front, the Federal Reserve maintained interest rates at 4.25%, demonstrating their continued cautious approach. Fed Chair Jerome Powell continued to emphasize his commitment to price stability and economic headwinds. The Fed's latest projections highlight the challenges facing policymakers. Officials now anticipate inflation will reach 3% in 2025 before moderating to 2.1% by 2027. This reflects the continued concerns that tariffs could drive inflation higher while dampening economic growth. Some think these rosy projections are a bit optimistic. We'll stay focused on the data and adjust accordingly. And finally, budget discussions refocused attention on America's fiscal outlook. The national debt now exceeds $36 trillion. That almost sounds like real money. And the Congressional Budget Office estimates that the latest budget proposal could add another $3.3 trillion in deficits over the next decade. Starting to sound like real money to me. Meanwhile, bonds played a stabilizing role in portfolios during a turbulent quarter. While stocks reached new all-time highs by the quarter's end, the journey included significant volatility. During times like this, bonds and other non-correlated assets helped our tiered risk management strategies provide stability for our long-term approach. As always, if it's time for your review or you just need to talk, please don't hesitate to reach out and give me a call or message me. I'm always available for you. If you found this information useful, I'm sure your friends will too. Please feel free to share, like, and subscribe to the channel. For the Dowden Report, I am Joshua Dowden.